Good morning, Michael.
Good morning, James. Thanks for having me.
Well, thank you for doing this. We're quite interested to hear what's going on with Aquila European Renewables. As usual, I'll give you a chance to tell us a bit about the fund first, and then we'll get some people to ask some questions.
Great, thanks for the introduction. So let's move on to the next slide. So an introduction to Aquila European Renewables, or AER. AER is an investment company which is listed on the London Stock Exchange, and it has an overarching objective to deliver a progressively growing dividend to investors by investing in a portfolio of renewable assets, which is primarily onshore wind, solar PV, and hydro. AER is European focused, so we only invest in continental Europe and Ireland, and there is no UK exposure for this fund. Diversification is also a key part of the investment philosophy, and so the portfolio is diversified by technology and geography, as well as having high contracted revenues. And the reason why this is a key part of the investment philosophy is really to minimize risks for the portfolio so that we can secure that dividend income stream to shareholders. The fund also has a long-term return target of 6 to 7.5% net of fees, with an aim of progressively growing dividends over time. Moving on to the next slide. So why invest in AER? Well, it's obviously well publicized that Europe is going through a green energy transition, and certainly AER offers a pure play exposure to this theme. So why is AER the right vehicle to gain exposure to this theme? Well, AER is advised by Aquila Capital, who is a leading European asset manager, and Aquila actually manages one of the largest clean energy portfolios across Europe, with over 19 gigawatts in clean energy capacity, and is also targeting 1.5 billion of CO2 avoidance across its portfolio by 2030. AER is well positioned within that market framework, given that the fund now has a fully diversified and operating portfolio with high contracted revenues, as well as an efficient balance sheet, which really puts us in a good position in terms of being able to progressively grow that dividend over time. Since IPO, AER has also delivered strong returns at the top end of its targeted return range. So on an annualized basis, the fund has generated 7.1%. Moving on to the next slide. The fund is really set up to offer a number of attractive features for shareholders. To start with, there is a strong alignment of interests. So the investment advisor is taking 100% of its fee in shares in the fund since IPO. In addition to that, a number of members of the board of directors, as well as the investment advisor employees, recently announced their intention to actually acquire shares on market. AER also offers compelling value. It has one of the lowest fees in the sector, coming in at 0.7%. And capital allocation is also very focused on maximizing returns for shareholders. And in February this year, the board announced a 20 million euro share buyback program, which I understand is that we were actually one of the first companies to do so in this sector. And since then, importantly, the fund has spent about 17 million euros of that commitment to date, which has reduced shares on issue by about 4% since December last year. Moving on to slide 5, it really was a record year for performance for the fund in 2022. We delivered a total NAV return of 12.9%, which was the highest on record for the fund since IPO. We also delivered strong dividend cover, coming in at 1.4 times. And if you were to exclude our debt repayments, that dividend cover is about 1.9 times. We also repaid about 13 million euros of project level debt during the year and maintained our low gearing levels at about 26%. 2022 was also instrumental for the fund in terms of growth, where the portfolio grew by over 80% following the completion of our various construction projects and acquisitions, which really resulted in a step change in earnings capacity. Moving on to the next slide, we really carried over that strong momentum from 2022 into 2023. So the company announced a 5% increase in its target dividend for 2023. We also completed our remaining construction projects within the portfolio. We announced a 12-month extension of our revolving credit facility. And as I mentioned earlier, there was insider buying commitments announced, as well as the share buyback program. Moving on to our track record, since IPO, the fund has delivered a total NAV return of 27.6%. As you can see on the slide there, all of our key KPIs are really tracking in the right direction. Dividend growth has been growing year on year. And we've really demonstrated how quickly we can increase the scale of the fund. It's grown by a factor of about 4 times since IPO. And commensurate with that increase in scale, ongoing charges have also been reducing as the fund has increased in size, coming down to 1.1% as a percentage of NAV. Moving on to the portfolio. So the portfolio at the moment is really well balanced and diversified. Again, the idea behind this is to really minimize risks and deliver secure income for shareholders. Our investments to date have really followed where the underlying weather resource is rich, and you can see in the north, most of our wind assets are located, and this is obviously where these regions really benefit from really strong wind conditions. Equally, our solar PV assets are located in Iberia, which benefits from very strong irradiation levels. And last but not least, we have a single hydro asset located in the north of Portugal, which is actually a region with very high precipitation levels. We're now quite diversified in terms of number of countries, but we're now represented in 6 different countries and power markets. And you can also see in the bottom right-hand side, we really have a balanced mix now between wind and solar PV technologies, in line with our targets that we set at the time of IPO. Why do we do that? Well, as I mentioned earlier, we aim to deliver a secure and growing dividend to shareholders, and we didn't want the portfolio to be overly reliant on one particular technology, because that also means you're very reliant on one particular weather pattern. And so by having wind and solar within the portfolio, it really enables a more balanced production profile over a given year. Moving on to the next slide. I mentioned earlier about how the portfolio has transformed, and you can see there the significant step up in operating capacity, bringing us to 464 megawatts at the moment, which was over 80% growth compared to where we were in 2021. So that really puts us in a strong position going forward. Onto the next slide. So in terms of dividend cover, that portfolio transformation has really enabled expectations of very strong dividend cover for the portfolio, which obviously helps to support our progressive dividend policy. And in February this year, we provided forward guidance of 1.8 times dividend cover in 2023, with an average of 1.6 times expected over the next 5 years. And all of those figures are net of our existing debt servicing commitments. That strong dividend cover also provides the portfolio with significant optionality in terms of being able to use that surplus cash flow after our dividend commitments for reinvestment opportunities, repaying debt on a discretionary basis, and returning further capital to shareholders. And as you can see on the left-hand side there, we've also run stress testing against those dividend cover forecasts. And you can see that even under very bearish scenarios, the dividend is covered over the next 5 years. Slide 11 provides an overview of our contracted revenue. At the moment, we're contracted at about 52% of revenue. And within that 52%, half of this is what we call government regulated tariffs, and the other half is fixed price power purchase agreements. Counterparties for those contracts consist of government entities, investment grade utilities, and corporates. And we also provide further details on that in the appendix in case anyone wanted to go into further detail there. Moving on to slide 12. We have been very active across the existing portfolio of assets as well. We were very active in terms of PPAs, and in 2022, we actually announced the signing of 3 PPAs across our Spanish PV portfolio, where we were really able to secure very attractive prices, almost at levels, almost at prices double that which we have observed in prior years for a significant portion of the portfolio, which again has really put us in a good position going forward. We've also been proactive in terms of our hydro asset in Portugal. The asset's portfolio capacity actually increased by about 1%, resulting in a valuation increase of just under 2%. And that was really a result of various improvements that our asset management team implemented across that portfolio in terms of improving control systems as well as refurbishment activities. We're also very active in terms of the capital structure, where we successfully refinanced 2 existing assets, and that those refinancings were highly accretive to returns. And we also upsized our revolving credit facility to 100 million euros and extended the tenor by a further 12 months. In addition to that, Aquila is also evaluating a brownfield battery storage opportunity for one of our existing Portuguese solar PV assets in the portfolio. And we're also undertaking due diligence on asset life extensions across the portfolio, which we can cover shortly. Slide 13, in terms of our gearing levels, we're currently geared at about 31%, compared to our existing restriction under the prospectus of 50%, which obviously gives us a lot of headroom and a lot of flexibility in terms of how we finance our growth going forward. Our debt financing across the portfolio consists of the 100 million revolving credit facility, which sits at the fund level. And the fund also has long-term non-recourse project financing, primarily in relation to our wind assets. And that debt is at the project level is fully amortizing with fixed interest rates. Slide 14, I mentioned earlier how AER has been actively investing in construction projects, which are all completed. And certainly the fund, if we look back to how the portfolio has performed since inception, certainly the fund has benefited from investing in construction projects. So since IPO, these construction assets have delivered about 18 million euros in valuation uplift. And there is also further upside to come for the remaining assets within the portfolio, where there is a small construction premium still in place that's embedded in the discount rate. And obviously over time that premium will be unwound, which will deliver further value upside. So now that the portfolio is fully operational, we will obviously look to continue to allocate to construction projects in order to continue with those value creation opportunities over time. Moving on to the next slide. So at the moment, given where the share price is trading, certainly we feel that there are attractive returns here on a forward basis with potential for upside. If we just look at the portfolio discount rate at the moment and the implied discount from the share price relative to the NAV, that would suggest a forward-looking return of over 9% across the portfolio, noting that assumes very conservative gearing levels of about 31%. And obviously, it's not just me saying that. As I mentioned earlier, the company actually announced its inaugural share buyback program in February this year. In addition to that, as the investment advisor, we are exploring asset life extensions across the portfolio. To date, our asset life assumptions have typically been more conservative compared to the market and compared to what these assets are potentially capable of. And so we are currently doing due diligence to roll out asset life extensions across the portfolio, which could be anywhere from 5 to 10 years across the asset base. And for those of you who saw our Q1 23 fact sheet, which was released a few days ago, we actually announced that we had implemented the asset life extensions across our Spanish PV portfolio. which resulted in about a 2% contribution to NAV for the quarter. Moving on to the pipeline, I mentioned earlier that Aquila currently manages a 10 gigawatt clean energy pipeline, which is one of the largest development and construction portfolios in Europe. That portfolio would require, we estimate, over 10 billion euros in order to bring that portfolio through to operations, which is obviously no small feat. And that really presents significant growth opportunities for AER, and importantly, that value creation process that I described earlier. In addition to that, there's obviously a number of new market opportunities for the fund to participate in as well. And you can see there that the Aquila portfolio has significant gigawatts in development and construction in new markets for this fund, such as Italy, Germany, and the Baltics as well. So really just to sum things up, 2022 was a record year for the fund. We delivered a record total NAV return. We also reported strong dividend cover. Growth in operating capacity has really transformed the portfolio. We're now 100% operational, and we expect strong dividend cover over the next 5 years. We also have low gearing in place, which also provides a lot of flexibility to support funding our future growth. We're continuing to roll out our asset life extensions across the portfolio, which is also a source of potential further upside. And the board and its investment advisor is also continuing to explore a number of different initiatives in response to the current share price discount to NAV. And then finally, in line with the prospectus, we have our scheduled shareholder continuation vote, which takes place next month. And the board recently announced their recommendation that shareholders vote in favour of continuation.